I have had this Amazon vertical put credit spread going on since last month. It was the 220 to 210 at the time of the trade. The price was 235. Amazon's dropped way down since then. Let's see, currently trading at 206. It's gone up a bit today. It was down as far as like 204, I think. Last night, the first leg of this, the sold put, was exercised early. So now I just have this one buy put left. And if I don't exercise this, it's just going to expire worthless. Typically, they would both expire in the money, and Robinhood would exercise both options at the same time. I'm not sure what's going to happen here because the 220 sold put was exercised early. So I think what I want to do is if I let this expire, I'll just have the shares at my cost of 220. I could go here, sell, call, go out like a month. If I own the shares at 220, then I go up to like 220 here, I could collect $330, but I'd be down because I could sell these right now at 210 and at least get 210 for these. And if I wanted to do a buy right covered call, I could buy these at 206 and then sell them at covered call closer to the money and make more money. So I think what I'm gonna do is just exercise this option. Continue. Why do you want to exercise this 210 put February, which is today, February 27th? I'm going to cover an early assignment. The short leg of my spread was assigned before the expiration date. So continue that. And it's just giving you some safety questions here. Should you still exercise? In these cases, you might want to sell or hold your contracts instead of exercising them. If the contract is out of the money, that makes sense. The put contract is out of the money when the underlying stock price is higher than the strike price. We are in the money, so that doesn't apply. Extrinsic time value is high. Contracts are often worth more when they're further from their expiration date. Well, that's today, the expiration date, so this doesn't really apply. It's too expensive. When you exercise a put contract, you've got to own the underlying shares to sell. I do own them because yesterday I was assigned 200 shares at 220, and I'm going to sell them at 210, which is a loss. I've collected, what did I collect on this? 214, and the spread is 1,000, so I'm down 786. So that'll be my loss on this. So I'm going to continue one contract, and I'll get $21,000 back into my account for this. Right around 25 bucks extrinsic value. View and submit. Not often you have to exercise an option, but that's how it's done.